this is obviously one of the example where I wanted to show you that every time you read a sentence, you need to know what this entails. I know it's messy, but remember again, the purpose is to show you where every cost goes, right? So forgive me for doing this, but I know that you would want to know every single detail. So it is this particular company, right? They it's Letsema, right? They are manufacturing the Jupiter star set, which is made out of wood, right? It is, what is it again? Doesn't really matter what it is, but it's a dining room suite, right? So, but they say this. Now you start paying attention. When numbers come, pay attention. They say that they use 20 kg of a yellow wood that costs 30 per kg. So I can see that to produce one, you need 20 kg of wood. The direct labor that you need to produce one of those sets is 400, right? So now we know that 20 kg multiplied by 30 rand per kg, the total is 600. So depending on how many we're going to be producing, I need to multiply the amount of units we produce. And what is the amount of unit we produce? 200 units, right? So 200 units times 20 times 30 or times 600 in total gives us 120. Automatically you need to be able to see that in order to produce those 200 units, we will need what is it again? It's yellow wood. Yellow wood worth 120,000 rand. Okay. How much will I need in terms of the direct labor? It's 400 for a set. So 400 times 200, right? 80,000. So these are even mental calculations you can do quickly, but I want you to be able to take notes, right? But what we were discussing in our chat, obviously, was to make a difference when they give you the factory space and they give you the administration space. For example, look at the rental amount of 10,000 rand per month. But oh, they tell you something. 10,000 rand per month. The tax and rate is 4,000 rand per month. But they say that there is a total floor space for the business premises, which is 1,600 square meter. They say for the factory. So if you heard me properly, you can do these calculations so quick. Look at the office, at the business premises, total space. They're going to give you for the factory and they're going to give you for the office area. So then you can do a quick calculation. What is the percentage that goes to the factory and what is the percentage that goes to the office area? So 3/4, for example, in this example that we have. But if you ask me, but how did you get a 3/4? 1,200 divided by 1,600. Very simple. That gives you 75% or 3/4 or 0.75. Does it make sense? That really makes sense, right? 3/4, these are fractions. Guys, if you're struggling with fractions, please remember that we have already provided the help on this, right? But that's it. Then I can basically do a manual calculation. I can say from the 10,000 rental amount, only 7,500, which is 3/4 of 10,000, will go toward the factory. And only 2,500 will go towards, that will be a non-manufacturing. Remember, this is an admin cost. It's non-manufacturing. So I need to keep that in mind. And in fact, this is, you need to practice this, but here it is. Look at the rental here. So when we're looking at the manufacturing overhead, for the rental cost, you will see it's 7,500. But 2,500 will go for the non-manufacturing. If you remember, non-manufacturing, 2,500. That will be the rental for the administrative cost. Administrative cost, non-manufacturing. This is quite a good example. And please, you need to be able to do it by yourself. Get the three musketeers. Who are the three musketeers? Sorry, three musketeers. There you have direct material, direct labor, manufacturing overhead. So you need to be able to calculate this, and then you add the total. So you have the total manufacturing overhead plus the direct labor and direct material, then you get the total manufacturing cost. Then you need to go now find what are the non-manufacturing costs. Admin, where are they? You find all the admin costs. The salary of the assistant, rate and taxes that apply to the office space, or the office building or the administrative building, the rents that apply to the administrative building, the short-term insurance premium that applies to the administrative building. If they give it to you over a year, remember that the example speaks about a month. Take the year cost divided by 12. Look at the short-term insurance for the year, 9,600. Hey guys, remember again, this is not your insurance that you're paying for the car. This is a company's insurance. They pay it on a yearly basis. So remember, don't confuse these things, right? Entrepreneurs, remember those kind of things, right? So you're paying on a year basis, but obviously we are talking about a specific month. So you're going to take that yearly premium, the short-term insurance for the year divided by 12, right? So I've added some more notes for you. I've added some more notes. If you refresh, you should be able to see some more notes. So anytime they're talking about admin, don't even think. It's always non-manufacturing. Because some of you might put the admin cost to say, well, but it is the admin that the secretary is doing for the manufacturing of the product. No, but it is admin. And if it is admin, it is non-manufacturing. All right. So these are things to pay attention. Pay attention. These exercises are very good. They help you to be able to allocate the cost to the correct place. All right. And another example also will be this one. Please do it by yourself. Whatever cost you found here, how are you going to allocate it as either a period cost or a product cost? Direct, is it direct material, direct labor, manufacturing overhead? All right. So this is straightforward. I want you to practice this. And if you are struggling with something, this is, for example, something that I've just added. I've seen that, some of you were struggling with this. The import tariff on question 4.2. Always remember, what are they giving me in the question? All right? There are 4 machines. Each machine produces 320 tons. But that is 80% of the capacity, right? They say if that machine work 100% of its capacity, it will produce 400 tons per month. But unfortunately, it's only working at 80% capacity, right? So if it's working at 80% capacity, it's 320 tons. Remember, it is 4 machines. What will be the total? You take 4 machines, 4 times 320 will give you 1,280 tons. Very important. You need to scrutinize what they're giving you. Scrutinize so you can see, okay, all right, okay. Now, they ask you now to put the cost in the correct place. I want you to do it by yourself. I still have poor connection there, but if you can hear me. Okay, guys, remember again, this one is an important one. Okay, perfect. The import tariff and customs, duty pays, and all those kind of things. They give it to you to say that it's 1,500 rand per 100 ton. So to get the correct amount, which is this import tariff, where does it go? Where does it go? I'm going to do it with you here. This is something I wanted to do in class with you. All right. So this cost is actually associated with your direct material because you need to pay an import. You need to pay an import to get this direct material. So this import tariff and customs is part of your direct material. So remember again, 100 tons, you pay 1,500 rand. Now for 1,280 tons, how much are you going to pay? Remember, 1,280 tons, how much are you going to pay? Basically, that will be the amount that you pay for the import tariff, and it is part of your direct material cost. So very important, and that's why I'm writing this for you to pay attention. Pay close attention. Right. Okay, guys. So we move on. You have fixed and variable cost. We've had some chat about this, right? Remember, a fixed cost is a total cost that doesn't move. You pay a rent of 10,000 rand. That's what you pay. It's fixed. You pay that every single year, right? But for the year, it is fixed for the total cost. But per unit, how does this cost react to the number, the volume that you produce? Very important. You pay 10,000 rand to manufacture 2 cars. If you add one more car, if the volume goes up, the fixed cost per unit will go down. If the volume goes down, the fixed cost per unit goes up. But you say, but this is so complicated. No, it's not. Just all the time use an example. So write down, if you are struggling, just write down, okay, the fixed cost I pay, it's 10 rand, and I produce only 2 things. 10 divided by 2 equal 5. So the fixed cost per unit is 5. But if I begin to produce from 2 to 4, now I'm producing 4 products. I will take that same 10 rand, that fixed cost, total fixed cost, divided by 4. What happens therefore? The volume went up to 4, but the fixed cost per unit goes down to 2.5 because 10 divided by 4 equal 2.5. Do you get it? So it's just use a quick example. If you're struggling, you don't know, is this fixed cost going up, going down? Just use a quick example, right? But obviously, perfect, perfect. Just use a quick example. This is something I'm giving you guys. So for cost behavior, just think and use a quick example to find out, is the variable cost will go up. The variable cost per unit always stays constant. It doesn't go up, it doesn't go down. It doesn't matter. No problem, Kiara, no worry. As long as you join, that's what matters. So the first part, you're gonna go through it. But guys, to finish, I wanna touch on this, the graphs. I wanna touch on this graph for total cost, fixed cost, and variable cost. So how do we find this total cost? Fixed, remember, fixed stays constant. The total fixed cost stays constant. That's why look at this yellow line. If you see the yellow line here, it stays constant, right? That's the total fixed cost. The variable cost, obviously, it grows up with the amount of volume, right? The more units we produce, the more total variable cost we get. But you know that the total cost equal fixed cost plus variable cost. That's the meaning of this graph. So these curves, this curve on top here, let me see if I can show it to you properly. This curve on top here, look at this curve on top. That's the total cost, which will include your fixed and your variable. Obviously, the total cost will start from 40, because we are paying a fixed cost of 40, right? So it could be, for example, rent. If we are paying 40 rent for rent, this is just an example. It will be more like 40,000, right? Whatever it is, right? But this graph is there to depict for you what happens, right? You have semi-variable costs. I've given you the difference between the two, semi-variable cost and semi-fixed cost. Very easy, right? But we want to focus on the example again on the number of units. We call it the cost behavior. How does the cost react to the number of units that we're producing? So you can see the total fixed cost stays the same, the total fixed cost, but the fixed cost per unit vary. So if the number of units produced goes up, the total fixed cost per unit goes down. So they have an opposite effect on each other. So the unit produced goes up, the total, the fixed cost per unit goes down, right? Very easy. Remember again to look at this. Very important. Another, the same example, but this time for variable cost. Remember variable cost? The variable cost per unit always stays the same. It always stays the same. What vary is the number of units. So if the number of units goes up, the total variable cost goes up. If the number of units goes down, the total variable cost goes down. As simple as that. Now we're moving on to the break-even analysis. Very important. We need to know, if we invest in this project, when are we going to be able to break even? You, as an entrepreneur, you always ask yourself that question. When am I going to break even? Break even simply means I'm going to be in a position where the total revenue equal the total cost. It means that I am not losing money, I'm not gaining money. All right, where I'm going to stop making a loss. Let me go to a beautiful graph here. There we go. This is the graph. By the way, if you're listening to this recording, easy, this is what you were asking, but I'm going to use this because that came from your question. You can see again this graph. We have a fixed cost. Look at the constant here. That's the fixed cost curve. It's starting from 1,250. Do you know the graph? You know very well graphs, right? Right. On this side, you have the price. So basically, it's a comparison of the price or the cost with the number of units. what happens to the cost, what happens to the revenue if the number of units goes up or goes down. We make a graph to make all that visually helpful, right? Visually helpful so that you can see it with your own eyes, right? So we have a fixed cost that is always constant. The variable cost always starts from zero and goes up. Why? Because if you're not producing anything, you get to spend nothing. All right? You're producing nothing. We will only take into account the cost. Remember again, we will only take into account the cost when the actual sales has been done. Remember that. Or the actual product in this case has been produced. All right? So zero product, no cost, no revenue. 6 product, 12 product, then the cost and the revenue begins, right? But remember again, the variable cost will grow together, will increase with the increase of product that are being produced, right? Guys, I need to pause there and ask you the question. Does this make sense? Perfect, Laika. Guys, say something, right? This is a graph and it makes sense. Wonderful, wonderful. I like that. Thank you so much, guys. But remember, if you are struggling in any way, please make sure you reach out to me. But this should be simple. But it shows you why am I showing this? And Kiara, you're a bit lost. No problem. But again, book a session. We can go through this. But if you can understand by this is not actually to go back again through the actual graph because some of you understand, the rest of the class would be able to get. All of you, if you go through the reading, you would get this. But I want to point out some of the things that are not in your textbook, but that will help you understand better, right? So look at the total revenue curve or line. Look at this line here, total revenue curve or line. It starts from zero and then it goes total revenue. Before it reached this point, E, which is the break-even point, guess what was happening? The total cost, look at the total cost line. The total cost was bigger. Okay, if maybe some of you will not see this, I'm going to, I don't know where my pen went, but, or, yeah. So guys, let me just show it to you here. This is the total cost line. It is big, it is greater, higher than the total revenue. What does that mean? It means that we were having more cost, we were incurring more cost than revenue. Our costs were bigger than our revenue. What does that mean? We were making a loss. That's all that it means. We were making a loss up to the point where we arrive at E. Point E equals to 30 units. So when we arrive at point E, we produce up to 30 units. Then at that point, we were no longer making a loss. And beyond 30 units, now our total revenue became greater. Do you see our total revenue here? It became greater than our cost. Is that clear, guys? Wonderful. So that's basically what it means. It means that you can track, you are in you need to be able to manage these costs. So by this you can see what the break-even point is. The break-even point is we reach a place where we're no longer making any loss. Yes, we are not making a profit yet, but we are no longer making any loss. So that's why you as an entrepreneur, as a future manager, you should be able, future financial manager, you should be able to pick it up. That break even is very important for the management of your business, because you can see, okay, but by how many, what quantity do I need to produce to break even? And then beyond that, everything that will be coming in, you will be getting a profit and not a loss, because your total revenue will be more than the total cost. So I think that this is quite clear. Guys, go through this example. Um, uh, Easy. I've added these two to explain the answers for question 4.9. These are the answers, but it basically says this: what is the total revenue? How do we get the total revenue? We take the selling price, multiply by the quantity sold. That's how we get the total revenue, right? A chair costs 10 rand. You produce 100 chairs. 100 times 10 equal 1,000 rand revenue. Income, right? The total cost, how do you get the total cost again? Remember, we have the fixed cost and the variable cost. So the total cost will be, we add up the fixed cost. Look again at the total cost curve here. Here it is in red, the total cost curve. What do? We take the fixed, this is the fixed cost, plus the variable cost. Then you will take these, will move parallel until it reach this point. That's this curve. Basically, this curve, this variable is what we have added to the fixed. Okay? Guys, I hope all of you can see it so clearly. I mean, that's the purpose of graphs. The graphs is to make it easy for us to see and to understand. So if you're struggling, let me know, right? Okay. So, and that's it, right? So this moves there. But I want to touch quickly before I finalize in the next 2 to 3 minutes. I want you guys to go and work on the other major thing. The other major thing is basically this: how do you get that break even? All right, there is the notion of marginal income, which I'm going to finish with. The marginal income, what does it mean? Okay, there is a bunch of formulas that are already provided to you. They are here. You have the marginal cost. Marginal cost, basically you look at the change in the cost of production divided by the change in quantity. Okay, so we are tracking that change. Remember again, we were talking about the cost behavior. When the quantity goes up, what happened? What happened when the quantity goes up? But this marginal cost speaks more to the variable cost. The marginal cost speaks more to the variable cost. So please remember that, right? We track the change and then we find the marginal cost per unit. Like for example, for this example, for the shoes, we know the change, they were producing 35,000. Sorry, they were producing 700 shoes and they increase it by 100 to 800. So there was an increase of 100 shoes that they increased, right? Now, when you're looking at how much money it brings, of course, it's going to bring more money from 35,000 to 40,000. So you take that 40,000 minus 35,000 gives you 5,000. You divide it by the increase in the production of shoes of 100. 5,000 divided by 100 gives you 50 per shoe. That's what we call the marginal cost. It is the cost of producing one more unit. That's basically what it is. Guys, remember your economics. Marginal means just one more. What is the cost of producing one more? So I hope none of you is struggling with this notion, right? So obviously, if we have the marginal cost, we can take the selling price. Let's say the selling price is 150. Selling price 150 minus that 50 rand gives us the marginal income. 150 selling price. How much profit do we get? 150 minus 50 rand of cost gives us, we get a profit of 100 rand. That's 100 rand per unit. That's what we call the marginal income. Why is that marginal income important? Because that marginal income will help us to deal with everything that is fixed cost. Basically, when we get that marginal income, we want to be able to pay our rent and all those kind of, those things that we incur before even we start production. We have to pay for rent. All right. So that's why you, as an entrepreneur, you're going to be worried about that. You're going to be like, how am I going to do to break even? Because I need to pay rent for my shop. I have this retail shop. Whether I sell or I don't sell, I still need to pay the rent. So that's why you can see the obsession with the fixed cost. So the marginal income is very important to ensure that it covers the fixed cost. Guys, does this make sense? Why we are making these calculations? We are almost there, guys. Does this make sense? Perfect, perfect. All right, so now look at the marginal cost ratio. It's going to be the same thing. Marginal cost ratio, you take the marginal cost divided by sales multiplied by 100. And what is the marginal income ratio? You take the marginal income divided by sales multiplied by 100. How do you get the break even? From the total fixed cost. Remember the break even? The break even is always when we have covered our fixed costs. Oh, no, I know it's decreasing. Okay, guys. So you have all these formulas. I've explained to you what these formulas mean. Go now and practice, right? I have covered everything. Please go now and practice. It's more than enough. Remember again, all this will mean nothing if you don't take the exercise and practice it. So practice. Should you encounter a problem that we have not covered, obviously I have provided a solution, some of the solutions, some of the questions I want you yourself to practice. But that will be it for today.